You've seen the headlines. Market manipulation, insider trading, colossal gains, and spectacular implosions. And what about the unsettling fact that even figures like Jeffrey Epstein ran one? Hedge funds occupy a strange space in the public imagination, a blend of immense wealth and dark secrets. But what is a hedge fund really? And how do these financial behemoths make their fortunes? Today, we're pulling back the curtain to find out. And at the very end, for anyone with the ambition to get a seat at that table, I'll share what it takes to get in. Let's dive in. You've heard the term mutual fund, right? That's the classic, safe as a sedan investment vehicle your parents probably told you about. Well, if mutual funds are the family minivan of the financial world, slow, reliable, and available to anyone with a driver's license, then hedge funds are the souped-up Formula One race cars. And just like a race car, they're not for just anyone. Hedge funds are essentially exclusive clubs for money, and the velvet rope is pretty high. To get in, you have to be an accredited investor, which according to the government means you're either making over $200,000 a year, or $300,000 as a couple, or you've got a cool million in the bank, not including your house. The official line is that this rule is to protect regular folks from the wilder side of finance. And while we appreciate the thought, it's pretty clear they think the rest of us can't handle the heat. Why all the secrecy? Because unlike that mutual fund that's legally required to play it safe, hedge funds can do pretty much whatever they want. They're the financial ninjas of the market, using unconventional strategies like shorting a stock or using leverage using derivatives. These are the moves that can lead to colossal returns or spectacular implosions, which we'll get into later. For now, just know that their mission is simple: to make money in any market, no matter if it's going up or down. Now, the popular image is that hedge funds are just playgrounds for the ultra-rich. And while it's true they cater to wealthy individuals, the bulk of their assets actually come from much more institutional sources. Think about it. Your teacher's retirement fund? That might have a slice invested in a hedge fund. Your alma mater's endowment? Likely dabbling there too. Even entire countries through their sovereign wealth funds. These institutions have long-term, fixed obligations to pay out regardless of market conditions. Imagine a pension fund saying, "Buddy, we can't pay you this month. The S&P 500 is down." Hedge funds offer them uncorrelated returns, which in theory reduces the risk and stabilizes cash flows. Hedge funds are designed to provide more consistent returns, a smoother ride, even if they secretly wouldn't mind beating the market along the way. Who wouldn't, right? The standard model is the infamous 2 and 20, a 2% management fee on the total assets they manage, and a 20% cut of any returns they generate. Think of the management fee as an expense ratio for an ETF. This is charged regardless of performance. The incentive fee, that's where things get interesting. The incentive fee is supposed to incentivize portfolio managers to employ strategies to generate a return. This presents a tricky balance. You want to incentivize risk without encouraging recklessness. If a fund loses money, that's where the high watermark comes into play. Suppose you lose money this year. Next year, you don't start from scratch. You have to recover all of your losses first. You have to earn money to dig yourself out of a hole to get that juicy performance fee. Some of these so-called multi-strategy hedge funds like Citadel, Millennium, Point72, and D.E. Shaw have well over $50 billion of assets under management. And that comes up to, let's see, $1 billion in management fees alone. Now you see exactly how these guys print money. Hedge funds employ several strategies to generate those uncorrelated returns, hoping to make money no matter which way the market is heading. Here are some of the classic moves: long-short equity. This is the bread and butter for many hedge funds. The idea is simple. You take a long position in a stock you think is a winner, say Coca-Cola, and a short position in a stock you think is a loser, let's say Pepsi, typically within the same sector. By taking both a long and a short position, you're essentially betting on the relative performance of one company over another, isolating your wager from the overall market's mood. The goal is to make money whether the soda market is booming or flat, a true financial ninja move. Arbitrage. This is about finding those tiny, fleeting price differences for the same asset in different markets. Think of it like a global game of Where's Waldo? With prices where the difference is a fraction of a penny, these tiny opportunities used to last for minutes. But now, thanks to our robot overlords, aka high-frequency trading algorithms, they disappear in milliseconds. They're a computer's lunch money, not a human's. Global macro. Then you have the macro funds. These are the big picture thinkers who fancy themselves experts on everything: weather patterns, financial markets, economics, and geopolitics. They don't mess with individual stocks. They make massive, directional bets on entire economies, currencies, or commodities. They're the ones who might bet $1 billion that the price of crude oil is going to skyrocket because of, because of something they read in a report that you and I will never see. And finally, quant funds. These guys and gals are the ones who got tired of listening to their gut. They use math, algorithms, and mountains of data to find trading opportunities and manage risk. They believe humans are too emotional and flawed, and that the market can be solved with enough computing power. Basically, they've taught a very smart robot to trade, and they're hoping it doesn't decide to take over the world, or at least not their corner of it. Now that you've seen the kind of magic they can pull off, you might be thinking, why can't I get in on this action? Before you get too worked up, let me introduce you to the other side of the coin, the spectacular implosions. Take Citadel's Wellington Fund, for example. They've bagged back-to-back 25% plus returns from 2020 to 2022, and in a particularly juicy twist, they made a 38% return in 2022, while the S&P 500 lost 18%. Since its inception around 1990, this fund has returned about 19.6% annually, nearly double the return of the S&P 500. Then there's Pierre Andorran's Commodity Fund, which was basically printing money with returns of 154%, 87%, and 112% from 2021 to 2023. But now let me introduce you to Bill Huang. His hedge fund, Archegos Capital, went from a quiet $20 billion firm to collapsing almost overnight in March 2021 after a handful of highly leveraged bets came spectacularly undone. The implosion was so epic it wiped out over $100 billion for all the other Wall Street firms caught in the blast. A sobering reminder that sometimes the house of cards is built with borrowed money. Then there's Melvin Capital, a once stellar fund that found itself in a financial street fight with a bunch of internet trolls. In 2021, the fund lost 53% in the GameStop short squeeze, at times blowing through over $1 billion a day in losses. Eventually, despite a $2.75 billion bailout from its friendly neighborhood rival Citadel in .72, the fund had to be shut down. It turns out even the pros can't outsmart a coordinated group of online traders. There are so many more stories to go on. Comment below which of these implosions you want me to do a detailed video on. So you've seen the money, you've seen the mayhem, and now you're probably wondering, how do I get a seat at that table? It's not as simple as sending in a resume, and unless you're a trust fund kid, the path is pretty narrow and straight up cutthroat. The most traditional, tried and true route is to get into investment banking at one of the top tier banks. We're talking Goldman, JP Morgan, Morgan Stanley. You basically sign up to work 100-hour weeks for a couple of years, live on coffee and lukewarm pizza, and generally sell your soul for the chance to make it to the buy side. It's a finance boot camp where only the most determined or crazy survive, but it's the golden ticket. But here's a little secret. The game is changing. Multi-strategy funds like .72 have their own training grounds, like the .72 Academy. Think of it as a hedge fund charm school for fresh out of college grads, where they groom you from zero to research analyst in a year. And if you're a tech wizard, you're in luck. Tech-focused quant funds like Citadel and D.E. Shaw are locked in a bidding war with Google and Meta for the best engineering talent. They're not just looking for finance bros anymore. They're looking for the kid who can write an algorithm that finds a 10-cent profit where no one else can see it. It's a different kind of hustle, but the rewards are just as epic. So yeah, no easy answers. But hey, now you know the playbook. So there you have it. The world of hedge funds, a place where the smartest minds in finance make colossal bets, chase down fractional profits, and sometimes crash and burn in spectacular fashion, offering both incredible rewards and devastating risks. It's a game of skill, strategy, and sometimes just plain luck. Now that you've got the lay of the land, what part of this high-stakes world should we dive into next?